people join this. That's fantastic. So welcome everybody. Good morning to CORFAC International's 2020 Virtual Fall Summit. My name is Phil Crane and I'm a principal with Providence Commercial Real Estate, CORFAC International in San Antonio, Texas. And as chairman of CORFAC's Professional Development Committee, it is my pleasure to introduce this morning's keynote speaker, Dr. Lawrence Yun, Chief Economist and Senior Vice President of Research at the National Association of Realtors, who will share an economic and commercial real estate outlook with us. Before we begin, please take a moment to mute yourselves during the session and feel free to use the Zoom chat to ask any questions you may have. CORFAC staff is going to moderate the chat box and pose your questions to Dr. Yun. That will be at the end of his remarks. Next, I'd like to thank our sponsor, CoStar. Will our representative from CoStar please say a few words? Aaron, are you on?
Yeah, hopefully I'm unmuted and hopefully you guys can hear me okay.
Yes, we can. Thank you.
Thank you. Well, thanks for allowing us to be a part of this summit. I know that we've had the opportunity to sponsor CORFAC and we appreciate the partnership that we've enjoyed for a number of years with CORFAC. In fact, there's some familiar faces on this call that we've had a chance to interface with over the years. So really appreciate the opportunity to partnership moving forward. Just as we think about the current market environment and some of the things that are currently going on, the one thought I did in talking to John a little bit earlier today, thought it would be good to just to share a little bit about LoopNet right now and the power of digital advertising and what we're seeing just from an interest standpoint. We know that this environment's probably more unique than it ever has been. And that's certainly an understatement at the least. And what we're doing is we're just really getting a chance to support the commercial real estate community through a lot of different forms of digital advertising, most importantly, LoopNet. And when we think about the unique visitors that we're seeing, we've actually seen a huge uptick. We have over 9 million unique visitors that are actually searching for spaces for lease and properties for sale. We've got some great products that are allowing to incorporate multimedia in those particular listings and those advertisements right now that increases both the time and the frequency of people that are searching online and allows you to space in your property prominently within the commercial real estate space and allows you to reach all the tenants as well as the corporations that are currently searching. So, I know that you enjoy relationships throughout the United States with CoStar, and we appreciate that. As the Senior Vice President of Sales, I manage the CoStar and LoopNet sales force throughout North America and appreciate your patronage and obviously the relationships we share. So I would just encourage you in this environment to reach out to your CoStar reps. We're here to help and we're here to provide some guidance and additional tools that both you and your clients may need. And just in the current environment, we find that the advertising is really coming high demand and we're helping with a lot of coaching and education around that as well. So anyway, thanks for allowing us to be part of this conversation, part of the Fall Summit. If there's any questions or any resources, please reach out to your team at any point, and we're here to help. So without further ado, I'll turn it back over to Jonathan and the team. I hope you guys have a great Fall Summit and look forward to continuing the conversation and the ongoing relationship with CORFAC and all the members companies. So thank you very much.
Thanks, Aaron.
Thank you, Aaron. Really appreciate it. Thank you and CoStar for y'all's support of CORFAC. We really appreciate it.
Thanks, Aaron.
So, without further ado, I'd like to welcome Dr. Yun as Chief Economist. He directs a wide range of research activity for the National Association of Realtors. He creates NAR's forecasts and participates in many economic forecasting panels, among them the Blue Chip Council and the Wall Street Journal Forecasting Survey. He regularly appears on financial news outlets, is a frequent speaker at real estate conferences throughout the U.S., and has testified before Congress. Sorry about that last part. He received his undergraduate degree from Purdue University and earned his PhD from the University of Maryland at College Park. Please join me in welcoming Dr. Lawrence Yun.
Thank you, Phil, for the introduction. Good morning, good afternoon, wherever you are. We are in a global connected economy, so I'm glad everyone is engaging. So we are certainly in this very unique times. I, as a role of the chief economist for the National Association of Realtors, have been monitoring real estate, and we are going through a divergent path. Housing market is thriving, surprisingly. Commercial real estate is not, except for industrial warehousing spaces. So we have current divergence, but as the economy begins to normalize, and we will see what that normalize means. Does it mean going back to pre-COVID days once the vaccine is discovered? Or will the virus somewhat linger, and also people will have some fears about taking the vaccine, and we will never get back to normal, or we will have a new definition of normal that is somewhat different from the pre-COVID days. So we have to wait and see how things develop. But let's go into some of the charts that I prepared for this presentation. One is the off-the-chart economic collapse that happened in the second quarter. But this is a government-imposed economic collapse. It's not somehow the economy suddenly say, okay, let's not do anything. It was just the case that in mid-March, I'm looking at the US, I know that in European countries it occurred earlier, that there was a tremendous amount of scare about the virus. We saw the TV imageries, people hospitalized, ventilators, many medical doctors in Italy actually dying because they were working on the coronavirus cases. So tremendous amount of scare. People did not know if you touch a doorknob, whether that is a death sentence. So the US government imposed a lockdown, just as many other countries did beforehand, Italy, Britain, Germany. So because of the government imposed lockdown, the economy truly collapsed. The way US computes the GDP, which is the total economic measurement, is they look at the quarterly change, how is it changed from one quarter to the next, and then they multiply by 4 to get an annualized rate. This is a standard method that US computes. I know in European countries, they compute it a little differently. They say, how much did it decline quarterly? So quarter to quarter is about 10% decline, not the 40% decline. But once the next data point comes, the next GDP update will really be few days before the US election. It will show the off the chart positive boost, something like 30% growth in GDP. But that's just from the reopening of the economy. So you had the economic lockdown, economic collapse, and then reopening, which will show quite a robust recovery that will be taking place. But for the year as a whole in 2020, it looks like the US will be down about 6%. China would be one exception. China is the second largest economy in the world. You can say they are the culprit for the virus or not spreading the news quickly, but they are actually able to squeak out a little gain in 2020. In fact, the latest data on their factory production that came out this week shows quite a lively activity in China. Japan will be down. The third largest economy, the fourth largest economy, Germany will be down. Britain is also being hampered by Brexit, so they will be down even greater. So you see essentially every country going into a decline in 2020. Consequently, the monetary policy across the globe is maximum liquidity, including the Federal Reserve here in the US. And maximum liquidity is the lowest interest rate that can pursue the Fed funds rate essentially at 0, but also including quantitative easing, essentially buying a bonds, whether it is US government bond, the mortgage debt securities, and also corporate bond for the first time ever, trying to provide maximum liquidity into the economy. And hence the interest rates are very, very low. So I put two graphs here. One is the 30-year fixed rate mortgage, which is the blue line, and the orange line is the 10-year treasury. So I guess for commercial real estate, many of the borrowing rate would be priced off the 10-year treasury. So you can see, given that 10-year treasury is essentially at a generational low, the borrowing cost should be very low, but only problem is they are requiring greater credit enhancement, higher down payments, the LTV to be low ratios. So we have low interest rates, but obtaining the funds could be a challenge. The stock market, at least prior to 2 weeks ago, was hitting an all-time high. I mean, we saw some correction occur last week. Today, some rebound, but even with those conditions appears to be quite elevated. And one may even say that price earnings ratio in the stock market is hinting that we could still see some price declines in the stock market. Now, some people say because of the low interest rate environment, this price earnings ratio can be higher than normal. So maybe a stock market is well justified. And secondly, as we go into 2021, economy is certainly expected to recover, expand, especially with the vaccine discovery. Everyone's crossing their finger. It could be this towards the end of this year or early next year as to when the vaccine will be available. So some people saying stock market overvalue, others saying it is justifiable given the low interest rate environment. But the REIT stocks is hurting. I mean, it is taking a punch right and left. The only exception that is holding up is data centers, some of the infrastructure, which means cell phone towers. So anything related to these technology, internet access is working well, as well as online shopping. So industrial warehouses showing positive return in the stock market on the REITs. But the other part, the retail, hotel, taking a huge cut in terms of the rate of return because, people are not walking the street to buy, going to the shopping centers or going to a hotel. So large pain in that area. Office is interesting because office rents are actually coming in, even though it's not being utilized. So you go to whether Manhattan office spaces in Chicago, it is vacant. Yet people are still paying rents because many companies, they are using at work, working from home, and they are still generating their revenues. And even though the office space is not being utilized, they are paying rents on time. Let me go into this non-real estate data. GPS, cell phone mobility. So we all carry cell phone, and as we move from one location to another, believe it or not, they track to see whether you are staying at home or moving about. Here is two states, North Carolina and New York. And I put two states as a comparison. So what North Carolina is showing is that the governor reopened the economy a little sooner and also in more expansive, meaning that you could dine indoors with 50% capacity part. While in New York, Governor Cuomo essentially said, we have to kill the virus. And way you kill the virus is to have a lockdown. And consequently, they are showing less GPS mobility. So people are stuck at home, moving less. Of course, now they have reopened. So now they are moving, but you can clearly see the difference between North Carolina and New York. So what is the purpose of me going into this? To show that there are costs or trade-offs. So in New York, unemployment rate shot up during the lockdown, and it still remains elevated. Many restaurants in New York City are saying they may be permanently out of the business because governor and the mayor refused to reopen the restaurant. While in North Carolina, they have shaved the unemployment rate. The economy is trying to normalize, and the unemployment rate at 8% is half the unemployment rate as in New York. And all 50 states were booming before the pandemic, low unemployment rate before the pandemic. But things have now led to large differences. Here's the map of the US regarding unemployment rate. So you see New York State, high unemployment. California, high unemployment rate because they also have a very strict lockdown. But if you go into, say, Georgia, low unemployment rate, or say Utah, very low unemployment rate, because they have reopened the economy earlier and sooner. So this is a major trade-off that all governors have to evaluate. Do they try to limit the virus Or do they try to reopen the virus at the expense of virus spreading? So this is a tough choice, and you see a large variation across the country, even though before the pandemic, all 50 states had a very low unemployment rate. Now, related to the total jobs in the US, this is over the past 20 years, from year 2000 all the way to today. The middle of the chart is the Great Recession, America and globally, where there was an economic collapse. That was from the financial market collapse related to the subprime lending, and many commercial real estate were a bystander collateral damage as the credit conditions shrank. There was very little funding for office spaces, any commercial related activity. So that was back in 2008 and 2009. From the low point at that time, it is the longest economic expansion in the US, 10 straight years of job creation. And you see the employment numbers reaching an all-time high. Then in a single month, the month of April, we lost all that jobs. So 10 years of job creation, all gone in a single month. But as the economies are reopening, you see that job creation occurring in the latest month. The past few months, you see the job creation, but that's only half the recovery. So we lost 20 million jobs. Now we have regained half of those job losses, 10 million. But we need another 10 million jobs to be fully back to normal, and we are not there yet. Airline industry will have hard time to recover until the business travel recovers, vaccine discovery. So some industry will take much longer, while other industry like the housing sector appears to be already back to normal. Variation in the job market. So this is, let me go back to the US. So keep that red line as a reference. Year 2000, Great Recession, then the pandemic lockdown. But in some places like Charleston, I mean, they're way ahead. So even with the job losses, you can see that they are well ahead of what it was in year 2000 or in 2009. While in Detroit, it's completely opposite because they were exposed to the auto industry. So they saw a large consecutive years of decline, then some recovery, and the pandemic hit, and then another collapse, hitting an all-time or two-decade low in terms of job situation in Detroit. The income situation in America is very interesting. The typical family income would increase around 3 or 4% each year. But during the pandemic, income actually grew by far larger percentage. And how is this possible in a time of high unemployment conditions? And the answer is massive stimulus bill. For US residents, you know that people receive $1,200 plus additional amount for dependent family members. But the unemployment insurance, many people who are in developing countries, they are completely wowed by the amount of the unemployment insurance. For someone, say, living in Illinois, the unemployment insurance is running, sometimes close to $3,000 per month. Those are just enhanced unemployment insurance amount. So the massive stimulus bill has really provided the income support during this pandemic period. Now, currently those enhanced unemployment insurance is over. Now it is less generous amount because people are saying those hugely generous unemployment insurance is preventing people from coming back to work. So they're trying to see what the right balance is. So with this high income, what are people doing with the money? They are not spending. So consumer spending activity is below 1 year ago. First, if the economy is locked down and the restaurants cannot open, well, you cannot spend money. If the baseball game, you don't allow fans to go into baseball stadium, well, you cannot spend money. So given that we are not fully reopened, people have been hesitant to spend that money or no place to spend that money. And if we look at some of the breakout, very interesting phenomena. Online shopping grew by 25%. So again, supporting the warehouse and industrial sector. Spending at the beer and wine liquor stores up solid 21%. Sporting goods, I guess people are at home, they don't know what to do, so they start buying hobby items. So it's up close to 20%. And also people spending more money on gardening and building material as they are trying to remodel their homes. What is down? Gas station, restaurants, clothes. If you don't have to meet people in person, why do you need new clothes? So clothes shops, shopping activity down. I thought this data is sort of intriguing and interesting. I guess not that much of a surprise, but at least one see the large variation on strong growth versus a collapse depending upon the sectors. Apartment rents. Apartment rents are holding on very well so far. In 2019, when the economy was at a very low unemployment rate, 90% of tenants pay rents on time. Remainder either delayed or they are not paying and they're getting eviction notices. But even in a good economy, 90% were paying rents on time. In 2020, during the pandemic period, it is down only modestly, 88%. So some people were really fearful that the rent payment would not hold up, but it's been holding up reasonably well considering the high unemployment situation. And this is due to, in my view, the enhanced unemployment insurance. People have the money and they are fulfilling their financial obligation. I know there are some social activists who are saying cancel rent, don't pay rent, but people are just saying, well, no, I have the money, I will pay the rent. So we are finding that for the most part, people are paying rents on time. The concern is the upcoming months, because unemployment insurance amount is a little lower, but fortunately we are creating jobs. So maybe the job creation will lead to people able to pay rent, but we still need to monitor very carefully as to what the rent payment will be in the upcoming months, given the low unemployment insurance benefits. Now, related to the transactions are really falling off. On some of the major properties, those property that is over $2.5 million, anything over $2.5 million, transaction activity down 68% from a year ago. So large, expensive property transactions coming down strongly. While when we ask realtor members who are involved in a lower dollar amount transactions, so it could be a bakery shop out in your neighborhood store, or it could be a gas station, so more smaller dollar amount, they are indicating that the transaction volume is down only by 5%. So we see a large divergence between large property transactions, which is essentially freezing, versus the smaller property transaction, which is holding on reasonably well. Commercial prices, two measurements. One is by Green Street, which is looking at the appraisal value of those contracts, not yet closed, but those contracts, and it's down 9.6%, more so in the San Francisco market and Manhattan. While if one looks at the other property index, it is still up 2.5%. Now, I would say that most of that growth occurred prior to the pandemic. So January, February, private prices were up 7-8%, but now because of some price decline month to month, but compared to 1 year ago, it is still up 2.5%. And let me give you this data from the Federal Reserve Commercial Real Estate Price Index. So so far, there's the data lag time. I think once the new data comes out, it will show some declines, and I actually anticipate that by the middle of next year, that it will be about 10% decline in the commercial real estate prices, especially on the retail, hotel, and some office buildings, because the rents are not coming in, and one has to evaluate the revenue flow versus the property price. But you can see from the Great Recession low point, prices have doubled. So even with some price decline, it will not be under tremendous stress unless it is a recent purchaser. So someone who recently purchased, they could go underwater, but a commercial real estate property that was purchased 10 years ago, there is a plenty of equity to absorb any, say, a 10% price decline that could occur in the commercial real estate space. Now we look at the delinquency, you can see that on industrial delinquency, which is the blue line, a very little, only 1% delinquency, but the lodging delinquency rate at very high, 24%, in the retail sector, 16%. If the restaurants further goes into closings, those numbers could rise. The CMBS market also, rising. So you see apartment sector, again, holding on reasonably well in terms of the delinquency. The e-commerce is clearly, dominant. It's been dominant over the past 20 years, but maybe the line is beginning to accelerate, or you see that convexity. So rather than a straight line, there's a curve, faster trend towards the e-commerce now, making up about 13% of all transactions. Globally, I'm actually surprised. It's actually making up about 15%. So I thought that US was most technologically advanced in terms of buying through online, but this graph is showing that US is slightly behind globally in terms of e-commerce transactions. So across the globe, this trend certainly will accelerate more given that the investment, you'd say the Amazon has pursued related to the online shopping, make it more easier, convenient for the consumers. We also took a survey. This is before the pandemic, so at least you get some picture about the country presence related to buying US real estate from abroad. So we asked commercial realtor members, if you had international buyers, where are they coming from? And China has consistently been number one, making up roughly 20% of the market. Mexico, our neighbor, number two. Canada, number three. Argentina, interestingly, is present. So you see different countries related to who are buying US properties. But keep in mind, these are smaller property transactions. If you look at the expensive properties, which our members generally do not engage in, like those expensive, say, $80 million office building and so forth, Germany clearly will be big presence, UK will be big presence, but for smaller properties, it is these countries that are around. And in fact, for Chinese investors, we always get, they just are looking for a safe place to take the money out of China. So sometimes if they can't take the money out of China, they do so and just park their money in US real estate. For those who did not buy in the US, those foreign buyers, so we asked commercial members, you work with these international buyers, you show many properties, yet they did not sign the contract. Why not? And they said because they simply could not find the right property that met their needs or had difficulty moving the money out of the country. The cost of the property, you saw the prices doubling in the past 10 years on commercial real estate. So some people say cost was high. Immigration laws also impacting, and then you see some other reasons. But before the pandemic, there was a lack of inventory on the commercial real estate, lack of inventory. And that was the number one reason given as to why they could not make purchase. And also on the international buyer trend is that given the reduction in the number of visas to the US, both business, tourism, investor visa, the amount of transaction, I think, to international buyers could diminish because this is clearly signaling. I mean, there's not a direct relationship, but certainly if there are fewer people coming in, then there is a fewer people looking at the properties. So just overall trend has been the fewer number of foreigners coming into the US. Dollar have been strong, which was another reason that hindered foreign purchases. But if there is a silver lining during this pandemic is that US monetary policy is maximum liquidity, meaning maximum printing of the money. Because of so much printing of the money, people are now beginning to say, maybe US dollar is not what it is. So we see some weakness in the dollar, and maybe this will induce some foreigners come into the US. I know many of the foreigners, they always like the top cosmopolitan cities of New York, San Francisco, Boston. And given that price declines in these markets, along with the dollar decline, maybe they see some opportunity in some of the high price markets. So we will be monitoring some of the trends in the high cost areas of, say, San Diego, Los Angeles, Washington, D.C. U.S. import and export also shows the diminishment. So U.S. clearly imports more than exports, but in relation with Japan, you see the collapse in the imports, especially from Japan, while the export is reasonably holding on. While with China, you see a huge collapse in imports. And maybe this is part of President Trump's placing tariffs, or just the sentiment that is coming from the White House related to China. So the import from China is really coming down, especially during the pandemic. Let me turn towards the housing market, because I think there is some opportunity for commercial real estate to be involved in housing, especially related to home building, land lot development, or just purchasing land. Because I will give you another reason why purchasing of the land may provide some return. First, housing market is showing a V-shaped recovery. So existing home sales are now above 1 year ago. Mortgage application to buy a home, which is an early indicator about future home sales, is 30% above 1 year ago. So very strong demand for residential home buying, 30% above 1 year ago. This does not include refinance. This includes only those indicating they're using the mortgage to buy a home, up 30%. So it's very, very good, strong, powerful indicator about home buying soon. But the inventory level is very, very low. We just don't have enough homes for sale. And how do we address inventory shortage? We need to build more homes. This chart is housing starts. How many new home construction? The early part of this chart shows excess. Builders built too many homes back in 2005, 2006, because of the easy lending case. Then we suffered through the foreclosure crisis. But from the low point, you see how slowly home building activity has been. So the cumulative effect of underproduction for 10 straight years is we don't have homes for sale. Right before the pandemic, builders finally went above that orange line. Orange line is the historical average. So I thought maybe in 2020, home building would be normal. Then the pandemic hit, and some states like, say, New York, Governor Cuomo said, construction workers go back home. You cannot build homes. So you see the decline. And now beginning to recover as the economy is reopening. What this means is that for the remainder of this year, 2020, we don't have enough homes for sale. So for commercial real estate, there is an opportunity to be involved in either home building or lot developments. You buy a land, clear out the trees, develop into subdivision. So there is an opportunity because we need to build more homes and there is a significant housing shortage. Where to build homes? Out in the suburbs and rural area and smaller towns and away from city centers. When we ask realtors, where are your buyers coming from or where are they interested in buying? And we have seen a shift away from city centers into going into the suburbs. Some of that reason could be the social unrest that turns violent, rioting, throwing of the bricks, like in Portland, Oregon. People think maybe those activities will come to their city and hence they want to just essentially get away from the city centers. So we hear some of that comments from the realtors about why clients made those changes. But I think the biggest reason for going to the suburbs is work from home phenomenon. Before the pandemic, only 5% of the workforce worked from home. During the pandemic, and I guess the timing on the technology is such that broadband access permitted people to work from home. So just by coincidence, if the pandemic occurred in 2018, I think America would have been in a devastating situation. But given 2020 with a wider broadband access, many people could work from home, and people are saying, I wonder if the company will begin to permit me from working from home for a longer period with greater flexibility. Facebook has announced that half of their workers will be able to work from home forever. Twitter has announced you can work from home forever. For many other occupation, non-technology, maybe they say you can work from home 3 days a week. Come to office 2 days. So if people do not have to go to office every single day, then commuting is not as important. And they say, why don't I have a larger size home out in the suburbs? So we may begin to see this trend. So if you are looking for development, buy those land out in the smaller towns, rural areas, as more people begin to think about working from home. And I think this simply accelerates some of the trend that may have already occurred, but the pandemic forced upon us. So if there is any silver lining in the pandemic is that work from home situation could quickly accelerate. If you represent a restaurant business in downtown, it's going to be extremely difficult. Maybe you want to advise selling at a deep discount, but the retail spaces out in the suburbs will be rising. People, I think, will still want to go out for lunch, say after the vaccine discovery. So if they don't have to go to downtown, well, they still want to do out in the suburbs. So there is an opportunity beginning to develop on the commercial real estate, say retail space opening out in the suburbs and in smaller towns and away from city centers. And here are some top counties which we believe that work from home will benefit. Forsyth County, outside of Atlanta in Georgia, we developed this number. So I think we consider like 10 variables. How many people are working in office-related employment, meaning that in the finance industry, insurance type, and where are they currently living? And then we looked at the number of computers, broadband access. So we consider many factors. So Forsyth County came out on top. Douglas County, right outside of Denver. You see the county in New Mexico. Collins County, outside of Dallas. Loudoun County, outside of Washington, D.C. So you see a variety of different counties which we think would be beneficiary of the trend from work from home phenomena. So this is a interesting development that the pandemic imposed on us, but now people are taking this as a long-term possibility. Another part is a blowout on federal budget deficit. Stimulus bill, where are they getting the money? Well, it's not from the tax increase. They are printing a lot of money to finance this debt, and printing of a lot of money, as we know, could cause inflation. Maybe it doesn't cause inflation right away. And I always give this example. America is very fortunate to have the US dollar because of the long number of years of credibility. If you have $20 bill, take it to Mexico, or take it to South Korea, or take it to Italy, or take it to Russia, and you show that $20 bill and say, give me a haircut, and they will gladly give you a haircut because people trust the US dollar. And hence, we can print money and not have inflation right away. But if we keep printing money, which we have to do again in 2021, certainly people may question the worth of the dollar. I mean, if you look at what's happening in Venezuela, they printed money, hyperinflation. You look at Germany 100 years ago, they printed a lot of money, hyperinflation. You look at Russia, Soviet Union collapsed, there was a hyperinflation in all these Soviet Republic countries. So America is printing a lot of money, and I don't think we will have hyperinflation, but I think we will have a little higher than normal inflation 5 or 6, 7 years from now. When I say higher than normal, inflation could be about 5%, 6%. What does that mean? That means people want to hedge against inflation. So what are some good hedge? Well, buy a gold, some tangible asset, or buy real estate. Homes, commercial real estate generally retains value in relation to inflation. So commercial real estate, of course, all the income generation, the rent payments, occupancy level, all that matters. But another reason why people may want to hold on to tangible asset is a hedge against inflation. So we may see some price decline in commercial real estate like office, hotel, retail sectors in downtown, but consider that as a maybe 1 year phenomena. But soon after that, it will either retain value or could increase as people consider, what is the right way to hedge against inflation. And the forecast, which contain many uncertainties, I have it at the following. So the GDP in 2019 are actual numbers. 2020, we still need to tally up the numbers. I think the GDP will be down about 6% overall. Remember, the second quarter was awful, but the third quarter will be quite amazing. And it comes like 5 days before the US election. I don't know if that's going to change a few votes or not. I know most people have already decided on who to vote for. But the year as a whole will be down 6%. Job losses, job creation is occurring right now, but it's insufficient to replace all the job losses. So it's a 4 million job cuts. The treasury yields will remain at historically low levels, but commercial real estate overall will be down about 10% in 2020, certainly by December, especially on the retail and the hotel lodging. The multifamily may see maybe the price decline in the low single digits, while industrial spaces may actually see price increases. And then we go into 2021, where hopefully things are more normalized. Vaccine is discovered, so GDP growth 3%, job creation, still low interest rate environment. By the way, Federal Reserve has changed their monetary policy stance going into the future. They're saying that inflation will be less important. Federal Reserve, before the pandemic, always said we are monitoring inflation. If inflation pops out, we're going to raise interest rates. But what the Federal Reserve is now saying is, if inflation pops out, we will not necessarily raise interest rate. We will wait and see. So, Federal Reserve is more relaxing about tolerating inflation. Again, tolerating inflation means people want to hedge. And if you want to hedge, get tangible asset like gold or real estate. In commercial real estate, I think there's some residual price decline occurring in 2021. So thank you for listening. I think I have spoken a lot, and I look forward to your questions.
Thank you very much, Lawrence. We appreciate it. So there are a few questions that came through while you were speaking. And then, of course, if anybody else has questions, you can either ask Lawrence, unmute yourself or put it through the chat. So Lawrence, the first question was, what opportunities are you seeing for commercial real estate in the next year or two? That question came early on, so you may have addressed it, but.
Well, the opportunity again is, out in the suburbs. So if you see some vacant retail spaces out in the suburbs, maybe this is a good opportunity to have where a restaurant opens up. Interestingly, lately I've been walking around the neighborhood where I live, and I'm actually quite surprised to see old restaurants shut down. But 1 month later, a new restaurant is opening up. So it's just change of ownership with different style. We also hear of ghost kitchens. In case you are unfamiliar with the concept of ghost kitchens, is that it's like a large cafeteria setting to cook many things, but it could be 3 different restaurants sharing a kitchen, not for the purpose of indoor dining, but for delivery. So it's only for delivering of the food, restaurant quality food. So ghost kitchen could be another opportunity. Industrial naturally is still rising. But on the downtown, lunch counter restaurants, it's going to be really tough. So if you want to make those transactions, you have to provide quite a deep discount immediately.
Andy, our friend Andy in New York, has a question which I think we all think of at times. Is there an explanation other than quantitative easing for the performance of the stock market? The high level of the market makes no sense given the unemployment numbers in the pandemic.
Yeah, so the stock market, first is that maximum liquidity. People say never bet against the Fed, but the stock prices that is rising, Apple, you have the Amazon, the technology companies that actually benefit from online at-home working, because as people are working from home or schooling at home, they're buying Apple computers, they're buying data centers. So it's partly reflected in that. But overall stock price justification, it always overshoot upwards, undershoot downwards. My guess right now is, my own personal opinion, I'm not a stock picker, is probably overvalued by 5 to 10%. That's my guess at the moment.
Another question, how does the possible election results impact your 2021 forecast?
So, politics is, especially such a divisive country that we have. I think some of the political analysts are saying the undecided voters are now actually only about 2% or less, which means people have made up their mind, and whether that 2% swing can make the election difference, or the uniqueness of the U.S. Electoral College is only about getting Pennsylvania and Wisconsin, that's what really matters. But the way we view election is NAR is one of the most powerful PAC contributors, Political Action Committee. So we donate a lot of money to politicians, but it's always at the congressional level or the local state legislature or the mayors. We never endorse president. Whoever is elected, we are going to work with the president. President Trump actually came to our conference 1 year ago to address the realtors, to say, I'm a real estate guy, I know what to do, and it's everything like this. Joe Biden has, said that 1031 exchange, he believed that this is a tax break for the wealthy and he wants to remove it. We are doing a lot of studies to demonstrate how 1031 is a very beneficial for the local economic development. So we are trying to counter those arguments right away. But President Trump actually came in his first year to remove 1031 before we showed the analysis to persuade him otherwise. But whoever is elected, we will work with. But it's a very divided country, and we'll see. If anything, cross our fingers that we would know who the winner is within the first couple of days after the election.
I have a question from Chuck in Orlando, and he asks, how will office markets in suburbs with more rooftops perform in the near future?
The concept of WeWork, those sharing offices, I think that is a perfect fit for this work from home environment. It just came in at absolutely the wrong time, and WeWork got whacked coming in at the wrong time from it. But going into the future, I think the suburban offices is where you may have some co-office sharing type of arrangements, because first, people are working deep out in the suburbs, and if they need to have an office meeting that require in person, they say, well, everybody come in. Maybe some people have a longer commute to go into this particular suburb, but other people may say it's more convenient. Satellite offices, I think in the suburb could be one of the growth possibilities. I think the Zoom technology, where you are meeting in person through Zoom, the way people are discussing the Zoom, those managerial experts are saying, is kind of cumbersome. You don't read people's facial expressions. You don't get immediate feedback. There's a longer pause when somebody interrupts. So it's less smooth type of meeting. So in-person meeting is still required. Before the pandemic, there was a study regarding at-home work from home versus in-office type of gathering. And they said the difference is that if you work from home, you can raise same repetitive activity part. So efficiency can be increased. Say you are mortgage originators. Coming to office, you may do 10. Working from home, you may do 11 because you are saving time on the commute. So you can actually do more. But innovation, new ideas always come from person interaction of the office person meetings. So I think this type of study, I think either Harvard, Stanford, as this message gets passed along to companies, I don't think they want to fully give up that office space because they want people to come in to have that interaction. But maybe it's only 2 days a week rather than 5 days a week.
We have another question, Lawrence. What are you seeing for home construction costs in terms of both materials and labor?
Oh yeah, you just first regarding the lumber prices, which have doubled, that's a huge barrier to home building. And that's part, tariffs on Canadian lumbers, which is hurting. President Trump also wants to get more home building done, so he has deregulated some of the federal laws so the home builders can be more active. But many of the regulation occurs at the local levels. So he's really tackling at the local and the state levels regarding building more homes. We try to relay the information to say construction workers typically make more than $1,000 per week, typical construction workers. People working in retail make about $500 a week. So if someone who lost a job working at Neiman Marcus was to go into construction, they would double their income. So is there some role for retraining some of the workers who lost jobs to go into construction, because certainly it's a higher paying job and we need more construction workers. Initially right now, I think some of the people who are engaged in commercial construction, commercial real estate construction, are now moving into residential, but still residential, they are saying that they simply don't have sufficient skilled construction workers.
And Lawrence, we had a fair amount of our international folks on the call. I know most of your presentation was targeted at North America, but any thoughts about, the general economic outlook in Europe? Are you able to address something like that in Asia? Is there a theme within those areas?
So just on the latest data, so this past few days, the activity in China manufacturing, those are positive signs, which means that there is some lift in the global demand for products. Second is the German factories are also humming along very nicely, showing that there is a activity goes on. So it's all about that lockdown. And the Sweden is very interesting, where they never had that lockdown, where they're just saying, be safe, social distancing. And they're seeing the number of the virus cases decline, while now Spain and France is beginning to see upward spike after the lockdown. You could go anywhere. The Australia economy is more dependent with China than, say, with the English-speaking world. It's the nature of how it has developed. And then you have all the emerging economies, the Russia, Eastern Europe, India. They're always been growing faster overall than developing countries, just because they're in an emerging economy status. They can do copycat technology transfer. But this pandemic has really led to this halt and sort of divergent path. Some economies doing a little better depending upon how their country decided to implement the lockdown. With Sweden, essentially no lockdown in Sweden.
I see one other question. We've got about 5 minutes left, so if anybody has any more, let me know. How will energy independence of the U.S. affect economy in the future?
Low oil prices helps most states except for Alaska and Louisiana. Texas has diversified, so they're less oil dependent now than so it's really Louisiana and Alaska, they need high oil prices to benefit, but the massive oil production that has occurred in some of the West Texas along with North Dakota, it really has made America far less reliant on foreign energy than before. And some of the replacement, not only oil, but natural gas. And interestingly, the use of natural gas, the fracking, which has a lot of pluses and minuses. But one interesting aspect, which on the natural gas that people do not actually discuss, is that during the greenhouse emission conference in Kyoto, where every major country signed the agreement to limit the carbon emission, except for the US. US did not sign. Yet actually US limited more carbon emission than other countries, even though US did not sign, just because the fracking and the natural gas and more people using natural gas, which produce far less carbon than before. So, but I think what's happening in California wildfires, and how much of that is the climate change, how much of it is forest management, people will debate those issues. But the energy independence, I think, is a great way to go. But I think this is one of the dividing points currently between Trump and Biden about how much of the energy extraction in, say, Pennsylvania and elsewhere.
I don't see any other questions. We're coming up on an hour. Lawrence, as always, incredibly informative. Thank you very much on behalf of CORFAC for doing this. For those who were on the call, thank you very much. This program is recorded, so we will share that link with you in the near future. And we've got a program tomorrow at the same time, deal-making session, and then a program on Thursday as well. And then we're going to do it all again next week, Tuesday, Wednesday, Thursday. So if you haven't signed up, please do so. And thanks again for being here.
Hey,
We'll see you
Jonathan,
soon.
there was one more question in the chat if you got a chance.
We might have, do we lose? Oh no, Lawrence still there. One more. Do you think more office space will be subleased for the short period?
That's going to be difficult because the way I see it is that even with the job recovery that's taking place or office job recovery, I just don't see how companies wants to expand their space. Maybe subleasing, smaller spaces for a temporary period, maybe they do. Just to give you one example, Deloitte and the consultancy companies, I see so many large buildings. Let's say they double their employment. I'm not sure if they are going to double their office spaces, given the new economy that we are in, where work from home clearly is showing that with a broadband access, many people can get the work done. So they may turn many of their current office space into more flex office where people come in and go. But I really don't see how a growth in employment will lead to normal commensurate increase in office demand. Thank you, everyone, and have a wonderful day.
Stay safe, guys. Thank you.